All right, everybody, welcome to This Week in Housing San Diego, April 23rd. Happy to be joined today by Andrew Paul, branch manager with Benchmark Mortgage. Very excited to have him here. Andrew, how are you today?
I'm good. Thanks for having me here, Ryan.
Yeah, you bet. You bet. All right. So some ground rules before we get going. Obviously, we need a time and date stamp material like this that we're putting out. Things are changing so frequently. So recorded on the afternoon of Thursday, April 23rd. Special thanks to Steve Harney and the KCM crew. A lot of the research and graphics, definitely borrowing from them. Other than that, we are recording this session, so people that have registered will get a copy afterwards. No problem there. Anybody who has any questions along the way, please feel free to type them into the chat box. We will be monitoring that as we go. We're probably going to try to save all the questions for the end. We'll just have to see how it goes as they're coming through. Andrew, anything you wanted to add before we get rolling?
Just at home, like most everybody else. So you got my lovely home office background here, and my wife and kids probably running through from time to time. So we're all getting used to the new normal.
Absolutely. I'm guessing that mine are right up there. So at some point, we're going to hear them too. So we'll make it happen either way. So, all right, here we go. All right, so our methodology, it's very simple. What we're trying to do is look for long-term and reliable resources for market information and analysis. We also want to understand the science that they're using behind that analysis. All right, and so the logos on the right-hand side, those are just some of the resources that we have used and pulled from in order to put this together. What we're trying to do is provide you guys with real-world actual information that doesn't have an agenda. All right. So disclaimers before we go. Nobody can give you perfect advice. All right. Not me, not Andrew, not anybody. If anyone is telling you they can give you perfect advice, run far and fast from them. All right. This is what we're seeing take place. Right. That's what we're presenting to you today. This is what the science has to say. And based on all that above, this is the best advice that we can give you as of today. All right, so here we go. I'm going to start off with Andrew with a mortgage lending update. I know that there's been quite a few questions about what's going on with the mortgage. They're hearing it's hard to get them, credit's tightening. So fill us in, what's going on with mortgages?
Yeah, so I'll give you some updates here, Ryan, and then if there's questions that people have, I can answer those as well. But there's a lot that's been changing in the mortgage world lately. Mortgages are all about risk, and people either call me, or whether it's for a purchase or a refinance, and they want to know what their interest rate is. It's all based on risk. The interest rate is a reflection of the risk relative to what's going on in the market. Of course, things move around, but the more you put down on a purchase, for example, the less risk there is for the bank, and so the interest rate's lower. So everything in mortgages is really about risk. It's about the shortest sentence I could use to sum up the mortgage world. It's all about risk. And so what's been happening lately has been a change in that risk and the appetite for risk. And it's translating to changes in liquidity. In other words, the money that's available for lending, and also the requirements or guidelines that tell us what requirements you have to meet as a borrower in order for us to be able to lend to you, and things like that. So first thing I'll do, though, let's talk about rates, because everyone's really kind of curious. Most people are hearing that rates are super low right now. A month or two ago, when people heard, you've got to be careful about what you see in the news and what we call like the headline, okay? Because the headline is very misleading from what's actually going on. A month and a half ago or so, the Fed reduced the rates to zero, and so everybody thought, oh, the Fed reduced the rates to zero, so does that mean that I can get a zero rate on my mortgage? So that just kind of, no, that's not what that means. And so just a quick note about that, and the Fed, or the Federal Reserve, their job is to create financial stability in the economy, and they do that by trying to stave off inflation when things are going really gangbusters, and they do that also by trying to stimulate the economy when things are going poorly, and they need to encourage growth in the economy, and they do that through what is referred to as monetary policy. And they have many ways that they do this. One of those ways is that the Fed controls several interest rates. One of them is called the Fed funds rate, another is called the discount rate, and those are rates that the Fed loans money to banks or institutions, and also they control the rate that banks loan to one another. So, at the end of every single day, every bank that's a depository bank, they're allowed to lend out a certain amount of their deposits. And then at the end of a certain day, they may be over or under that. And let's say that they've loaned out too much for the day. They're just lending. And all of a sudden, at the end of the day, the books balance out and they realize, oh, shoot, we've loaned out too much money. We need to have more on deposit relative to how much we've loaned out, okay? So what they do to shore up the books is they can borrow money from the Federal Reserve. So when you hear that the Fed reduces rates, that's really the rate that they're controlling. They're controlling the rate that banks borrow money from the Fed to balance their books and things like that. Now, how does that control and translate to interest rates that you and I see every day in the mortgage world when we're trying to buy a house or refinance? Well, if the Fed raises the rates, the cost of the money that they charge banks to borrow from them, banks will be more apprehensive and less likely to loan out their own money. Because if they loan out their money and all of a sudden they don't have enough in their, they've loaned out too much relative to their deposits, they've got to turn around and borrow that money from the Fed to balance their books for the night. They do this every single night. And if the cost to borrow from the Fed is high, well, then the banks are going to be more conservative and lend out less of their money, okay? On the same token, if the Fed lowers their rates a lot, it creates a situation where banks can borrow money from the Fed really cheap. Like right now, the Fed has lowered that the target Fed funds rate to 0 to 0.25%, basically 0%, which means that big institutions can borrow money from the Fed at 0%. They can turn around and lend it out to you and me at 3.5%, 4%, whatever it may be, and make that as profit. As the rates are lower, people can borrow more money, they can spend more money, and that stimulates the economy. So that's really what the Fed's role is. So just to be clear, the Fed doesn't control the rates that you and I see every day, but they influence them. So when the Fed reduces the rate to 0, doesn't mean you and I get a 0% rate. What it means is that they're making money cheap to borrow for big banks, so that the banks and the institutions may then borrow that money from the Fed cheaply, turn around and lend it out cheaply to you and I, so we can then turn around and use it, spend it, and that's what keeps the economy going. Okay, so why would the Fed lower rates like that? Why would they try and influence rates lower? Well, that's because the economy looks like it's maybe not doing so hot. Right now, we have, I don't care where you stand politically, whether you think we should go back to work or stay at home for longer, doesn't really matter. It's not what I'm talking about here. We have shut our economy down. Like, we're done. There are businesses that have closed that will never reopen. There are businesses that have slowed way down and are going to struggle to come back, and there are some that are going to thrive right now. But our economy has taken it in the shorts right now, and the Fed needs to stimulate this economy, so they're pushing rates down. As the economy takes off and we start to experience inflation, the Fed will attempt to lower inflation by raising the rates, so it becomes more expensive to borrow. That takes me to, okay, rates. Okay, all that discussion, first I want to get to this statement, because people are saying, well, what are rates doing? Well, rates are low right now. And now this is the part that I think will be valuable for you in making a decision about refinancing or buying a home or having a discussion with your mortgage professional. The question is, what are rates going to do in the future? Well, I don't have a crystal ball, and I don't know that answer exactly. I mean, if I did, I'd be taking this call from a beach in Hawaii somewhere, but look at the economy. The economy is not doing well right now. We were a few months ago. We were doing amazing. The stock market was putting in all-time highs. We had record low unemployment rates. The economy, by all metrics that we use to measure the economy, were doing was going gangbusters. Now the economy is not doing so well, obviously, and it's going to take some time for that thing to recover. So when people say to me, hey, what are rates going to do in the future? Well, I can't tell you if the rate's going to be 2.5% next week or a month from now. But I do think rates are going to stay low for a while. How low? Don't know. Now, this is what's important. We're doing, right now in the mortgage world, we are swamped doing tons of refinances for people, right? People are taking advantage of the lower interest rates. And this is the word of caution that I would give you. I had this conversation multiple times a day with people. They'll ask me, they'll say, well, Andrew, that 2.75% rate sounds really good. But I mean, do you think they might go a little bit lower? Like, could I get 2.5% maybe? And the reality is, I don't know. And this is the important advice I want to give you. this is somebody I'm talking to, for example, that's got a 4% interest rate right now. And I can reduce them down to a 2.75. And, we get, without getting the details of the costs and the APRs and all that type of stuff, they're going from a 4 to a 2.75. And they're going to save $350 a month on their mortgage payment, just for example. And they say to me, well, should I wait? With the rates, might they go down to 2.5%? I said they might. But they also, for a number of reasons, which I'll get into in a minute, they also could spike back up again. And so the advice that I'm giving people right now is it's the classic bird in the hand is worth two in the bush. All right. I don't know what the rates are going to do next week or next month, although I do think they're going to stay relatively low for the foreseeable future, like the next couple of months, maybe. Will they go to 2.5? I don't know. What I do know, as I'm saying to this particular type of a client, what I do know is that right now, I can refinance you from your 4 to a 2.75 and save $350 a month. That I know. And so, what I watched happen this in the first quarter of the year, the rates began to really drop off, and then we hit some of this liquidity issues that we've experienced, and the rates shot back up again, and a bunch of people lost the opportunity to refinance. Then the rates came back down into range again, and a lot of people are refinancing again. And all those people, when the rates came back down in range, they're like, sounds good, I'll take it, do it now, right? They lost out and almost lost out the opportunity to refinance. And so that's the advice that I would give you right now. If you're looking to refinance, where rates are now, they're low. Bird in the hand, if you can save money, if the cost relative to the monthly payments, the break even is a reasonable amount of time. So you want to look at a break-even analysis. So just for example, if the total costs were, $3,000 and you're going to save $100 a month, you take the total cost divided by the monthly savings, and you look at that recoupment period. In that example, it would be 30 months. It's just 2.5 years. How long do you plan on keeping the house for? I'm going to save $100 a month. I'm planning on keeping the house for 5 to 10 years. I'm going to recoup my costs in 2.5 years. That would make sense. But could they go lower? I don't know. So be careful that you're not.
Let me hop in real quick. So we had some new people that have been trickling in as we've been going. So for those of you that have just come in, we were on with Andrew Paul, who's one of the branch managers over at Benchmark Mortgage, one of the top lenders in the county, without a doubt. He's basically just giving us a lending update, kind of what's going on. So again, anybody who's new, if you guys have any questions, please feel free to type them into the chat, and we'll get right to them either at the end or as we go. So Andrew, keep going, please. Sorry about that.
Yeah, so basically all that little kind of intro piece on the Federal Reserve and what's been happening to rates lately, the big piece of advice that I can give you is now is a fantastic time to take advantage of lower interest rates. But be careful that in your effort to chase some savings, which you should take advantage of and at least explore, if you get presented with a rate that's really good, you can save a bunch of money and the break-even time makes sense, people have a tendency to lose out trying to chase just an eighth or a quarter better in rate, and then they lose out. Right now, it's a classic bird in the hand is worth two in the bush. Okay, so that's the best advice I can give you. Now, in terms of your specific situation and does it make sense to refinance? Well, again, you got to look at your current rate, projection, the rate being offered, what the costs are, how much you're going to save, the interest saved over time, the break even, and see if that aligns with how long you plan on keeping the house. It is a good time to refinance. The rates are low, but if it makes sense to refinance, depends on your specific situation. But just again, don't chase like an eighth veteran rate. You could lose out, as I've seen a lot of people. The swings in the rates have been pretty volatile. They go up and down, up and down. People are, while they're thinking about it, hoping to get an eighth better rate, they lose out altogether. And then they got to hope that it comes back again in another week or two. And sometimes it does. And then they can jump back in. But also on that note, more than just what's going on in the rates, I want you to understand what's going on in the industry right now. In the mortgage industry right now, lenders are inundated. They're absolutely flooded with requests. I can tell you, for me, I am so inundated, I'm having to focus my time and attention on my past clients first. You go to a big box retail bank, forget it. There are some banks that are quoting 6 months turn times to refinance. 6 months is how long it will take for them to refinance your house. That's an actual thing I got from a bank, okay, in writing, 6 months. So The other thing that I see happening right now is loan officers, um, banks, underwriters, the whole system is overwhelmed right now, just absolutely overwhelmed and inundated. And so if you are able to get in line and speak with a professional who will take care of you and give you a deal that makes sense, and they can do your loan in a reasonable amount of time. The danger, and I'm not saying not to shop around, because you should make sure that the deal you're getting makes sense, but what's unique that's happening right now is this is the analogy that I see happening. People are, it's like you show up at Costco and you get in line for the meat counter, and the line's out the door, right? So they say, take a number, right? And you finally get up to the front of the line, you finally get an appointment, you finally get the quote, and they say, okay, I can give you this rate, or they say, hey, these steaks are going to be $22 a pound, and you're like, oh, that sounds pretty good, but I'm going to go run down to Vaughn's real quick and see what they've got for me. So you run down to Vaughn's and you find out Vaughn's is charging $24 a pound, and you're like, oh no, Costco is better. Hey, Costco, cool, I want that deal at 22 bucks a pound. And they're like, hey, the line's out the door, man. You got out of line. You got to take a number and get back in line again. I can't even talk to you until next week. I've got appointments stacked 5, 6, 7, 8, sometimes 10 a day, back to back to back. That is how inundated the industry is right now. One last perspective on that to show you how inundated the industry is. When these rates came down, I saw a report, a study about a month ago now, that said as these rates came down to about where they are now, so in America, in the country, there's about 11 trillion in mortgage debt. Okay, that's all mortgages combined. That's my mortgage, that's your mortgage, first, second, home equity line. There's about 11 trillion in mortgage debt. Okay, and when the rates came down, this study showed that it was estimated that between 40 and 60% of all mortgage debt was in a range that it would make sense to refinance. Okay, so it's 11 trillion in mortgage debt, and somewhere between 40 to 60% of that is in a range that it would make sense to refinance. So let's just say that that's 6 trillion in mortgage debt. Okay, 6 trillion in mortgage debt is in the range to refinance right now. Okay, any idea how big the mortgage industry is? I'll give you an idea. And the last collapse, okay, the industry shrunk to just under 1 trillion in total mortgages done in a year, in 08, 09. And when it went below 1 trillion, everyone was like, oh my God, the mortgage industry is imploding. Last year, the mortgage industry had its biggest year ever and closed about 1.8 trillion in mortgages. That's the most like the industry. That's all banks, credit unions, big banks, brokers, everybody closed about 1.2 trillion, 1.8 trillion in mortgage debt. So if that's the capacity of the industry, I'm talking about everybody. The whole industry has the capacity to do 1.8 trillion in loans in a year. It would take 3 years for the industry to chew through all 6 trillion in mortgages that are in a range that are eligible to refinance. So that's just the last piece I would give you, just to have a little perspective on just how inundated the industry is. So if you've got a professional that you work with, if they have the capacity to do your loan, and they can get you in and get you your rate locked in at these great rates, take advantage of that. That's the big thing, is that people are just they're losing out by either hoping for an eighth bet or somewhere else, or running down the road or something like that. So that's just kind of some interesting things going on. Last little piece I'll tell you about is there has been some tightening in some credit guidelines. You're seeing mortgage companies across the board beginning to raise their minimum credit scores to do loans. It's different from company to company. I did just hear that Chase came out and said that they are going to require a 700 credit score on all loans going forward. That was something that was in the news media. I mean, I can tell you our guidelines aren't like that. And it's different depending on conventional VA, FHA, et cetera. So you are starting to see some tightening in the credit markets. Just lenders don't want to be that bank holding the 590 credit score loan where nobody's willing to take that loan. And so lastly, I would just say too, in my world, I can tell you that jumbo loans are gone. Like we can't even do jumbo loans anymore. By jumbo loans, I mean a loan amount that exceeds the county loan limit. So for San Diego County for 2020, that loan amount is $701,500. So you can't get a loan for more than $701,500. Otherwise, it'd be a jumbo loan. Now, some of the big retail banks in-house will still do a couple of those, but they're going to want 720 or better credit, 20 to 25% down, in 6 months to probably close it. So what we're doing is we're just getting a little creative using first and second. So using a combination of a conventional loan in combination with a home equity line second, so that we don't have a single loan that steps up into that jumbo category. And why is that? There's just no appetite. Investors that ultimately provide the liquidity for loans to happen, nobody wants to be stuck holding that hot potato. The reason why the loans below the jumbo exist still is because of Fannie Mae, Freddie Mac, and Ginnie Mae. Those are the three GSEs, or government-sponsored entities, that provide liquidity to the mortgage industry as a whole. They become the buyer of the notes at the very tail end, and this is what provides that liquidity. If it wasn't for that, it was, in general, I don't just mean us. Mortgage companies around the world, country, wouldn't be able to do loans. So for now, we're seeing a real lack of liquidity in the jumbo market space. So those are some of the updates they've got. I could go on and on and on and bore the crap out of you guys. But if you got questions, you can fire them away. But that's a little update on where rates are. Again, just in summary, I think rates are going to stay relatively low for the short term, just because I'm looking at what's going on in the economy. When I start to see that economy turn around, that's your key. The rates are going to go up. There is some tightening in the credit markets due to credit scores and things like that. And jumbo loans are a bit of a unicorn these days.
Yeah. All right. I love it. A couple things, just I want to put a little finer point on some things. So when Andrew was saying the difference between the rates, he was saying going from the low 4s to the high 2s, and he gave out a random number of $350 a month that you're saving off your mortgage, right? That's $126,000 over a 30-year mortgage, right? Just to put that into perspective for you. And then the other thing, Andrew, talk real briefly about the person that's waiting for whatever reason it is, and instead of the rates coming down, what happens if they bump up 0.5%? And let's say that this is somebody who you had just pre-qualified for, let's say, a $1 million purchase. What did that do to their purchase power?
Well, there's a bunch of moving parts there, but it could be, it could be anywhere from $20,000 to $45,000 or $50,000 in buying power. So just depends on the taxes and things like that. But I don't. The point you're getting at is a point that I remember talking in depth about several years ago, when we were at that time at what was the low before we kind of went back up again. And that was the conversation. And I think the point that I would make about this, that maybe you're getting at, Ryan, is when you're out there looking at homes right now, and Ryan, you're on the real estate side, I'm on the mortgage side, okay? But sometimes we look at a house and we go, well, I like that house at $700,000, but man, I only want to pay $680 for it. And you negotiate back and forth, and the seller's willing to come down to $690, and you're like, well, I'm not going over $680, and the deal falls apart for $10,000. Okay. This was a big deal a few years ago. What I was telling people, what I recognized anyway, was that the opportunity right now wasn't so much to buy the home as it was to buy the home and lock in these historically low interest rates. So if you buy the house for $690, which in this example is $10,000 more than maybe you wanted to spend, right? Because you're focused on that dollar price. You're like, no, that $690 is too much. I'm not overpaying. $680 is as high as I'll go. Okay, fine. But rates go back up, and then you look at the interest that you pay over time. Even if you had gotten it at $680, you're going to pay more, as opposed to, hey, pay the $690, get the 2.75, 2.99 rate, whatever it is, and the payment is still lower because of so in other words, the opportunity is in the rate right now, the rate environment. The opportunity to lock in a 30-year fixed mortgage in the high 2s, it's just, I can't even believe it. Like you should borrow as much as you can right now for as long as you can. And as inflation goes up, it'll inflate that debt away, and it'll make the payments feel even smaller and lower as things begin to turn back around in years to come. Yeah. So anyway.
All right. Good deal. All right. We do have a few questions, but we'll save those for the end. So, all right, let's keep moving here. All right. So, real estate, what's going on the ground here in San Diego and nationally? Let's talk San Diego real briefly. So key metrics, median sales price, that's obviously something we want to take a look at. Median is going to be your middle of the road number, not an average. We always want to look at the median. It removes the super cheap price and the someone overpaying. So we're at 591,750. That is 6.4% higher than a year ago for the month of March. This is a new all-time high in San Diego County. This has never been this high before. When we're looking at median days on market, homes are lasting for approximately 90 days. That is 52% less than it was a year ago. Months of inventory, we're going to see this come through again. We're at 1.8 months in San Diego County. That is 28% under where we were a year ago, right? Now, keep something in mind. The month of March traditionally is the start to this season really heating up here in San Diego, all right? Active listings, 5164, that's down 26%. New listings, down 18%. Pending listings, meaning property was on the market and listed, they accepted an offer and moved from active to pending, down 23%. Sold listings, down 0.7%. All right, so now, what do we need to know about this? All right, the median pricing, it's continuing to go up. It has been ticking up since November. We have actually, I believe, seen 3 consecutive months in a row where we have set a new record each month. When it comes to the time on market or days on MLS, 9 days. You got barely over a week to figure out whether you really like this property or not. Months worth of inventory, we're going to get to that here towards the end when we get to the market. When we're talking about active listings, meaning someone that is saying, hey, here I am, I need to sell my house, and they have to jump through some hoops. There's paperwork, there's documentation, etc. We're down 26%. All right, we started the year with a historically low inventory, number of homes for sale. All right, and so this hasn't drastically improved, but it has not drastically dropped off, right? The number 26% down for active listings, that's maybe 10, 15% higher than what we were seeing pre-COVID, okay? With new listings, that's still a good sign. They're ticking up. We're going to see that here in a minute. Pending listings is the big thing to take a look at. That means people are actively writing offers. Sellers are accepting them. They're going into escrow, all right? So we're down 23% right now. That's about to be expected with what we're seeing with the coronavirus. Sold listings are misleading, okay? Anything that we're seeing right here, this is from the month of March. It's a complete data set. That took place 30 days ago prior to that, right? So these are homes that accepted an offer and went into escrow in February, more than likely, right? So this is definitely lagging behind. All right, so here's a quick graph of the active listings that have been coming on the market. So we're starting at March 1st on the left. We're to April 22nd on the right. The red line you see going up and down the middle, that was when Governor Newsom gave the stay-at-home order. You see that the active listings pretty much plummeted, and then we've just been bouncing around. Right? We have days of the week that we know we're going to have more listings coming on. Saturday and Sunday don't have a lot of new listings hitting the market. Right? So Wednesday, Thursday, Fridays tend to be the hotter days, and we're definitely seeing the peaks in that regard. The valleys are going to be down on the weekend. All right. So homes are coming on. We're bouncing around. There is business taking place. All right. Pendings is a different story. Right? And this is a little bit of a more accurate reading of what's going on. We can see the market before COVID came around, before the stay-at-home order was issued. Right? This was lower than we were used to seeing on the left of the red line, but still not bad. We see the red line, and basically we plummeted down to barely above 20 properties that accepted an offer. The promising thing about this is if we look at what would be a line of best fit, we can see that we are trending upwards in the number of offers that are being accepted. Right? That means business is picking up. That is a good positive thing for us. Right? So that's what's going on in the actual market with some real world numbers here in San Diego. All right. So now let's get into the heart of this. We want to talk with you guys briefly about the recession. Like, what the heck is going on? Are we in one? Are we going into one? We want to talk briefly about the unemployment. The reason we wanted to talk about those two is we want to be able to use that as a frame of reference for talking about the housing market. All right, so here we go. Recession, the definition, a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP by 2 successive quarters. All right, what that means to us is we have to have Q1 and Q2 of this year or Q4 of 2019 in a row. We need 2 in a row, right? The numbers from Q1, January through March, those are still estimates. They have not finalized them. Everybody is pretty much agreeing we are going to be in the negative numbers for Q1. That's January, February, March. Q2 will also have to be negative. Q2 doesn't end until July, which means it's going to be August before we get those numbers. Are we technically in a recession? No, we're not. Absolutely not. Are we functionally in a recession? Yes, we are. All right. So splitting words, call it what you want, but that's basically where we're at. So the different types of recessions. All right. We have a V shape, a U shape, and an L shape. The tennis balls on the left is a kind of a very good analogy that the Keeping Current Matters crew came up with, the KCM crew. So let's dig a little more into those guys. So as we see the graph coming across, the V shape is like a brand new tennis ball, right? So we basically have a very rapid fall to the bottom and we bounce straight back up and recover, right? So that's our red line. The U shape is kind of the ugly brother of the V shape, right? We would much prefer a V shape than a U, right? So basically the U shape is going to be a little bit slower going down, and then it's just not going to have a well-defined trough in the middle, right? And that's what we're seeing by that longer purple area. And then ultimately, they tend to last longer than the V shape. The recovery can tend to be rapid also, all right? The L shape is the last one. That's a tennis ball that the dog has chewed, that you've played tennis with for about 10 years, and you try to bounce it off the ground, and it bounces back up by about 1.5 inches, right? So that's the L shape. We have a rapid drop to the bottom and flat line, right? And so basically, that L shape was what the first portion of the housing crisis in 2008 looked like, all right? So there's just a little bit about it, for, recessions for you guys, so everybody kind of understands what the heck we're even talking about. So from there, we're looking at a newer graph that had come out, just came out on the 15th. So this is Morgan Stanley, Goldman Sachs, JP Morgan, Wells Fargo, Merrill Lynch. These are the top financial companies in the world, right? Just between Morgan Stanley, Goldman Sachs, and JP Morgan, they're managing over $1.7 trillion, right? Just give you kind of an idea of what we're talking about. So the graph that we're looking at, we see the projections from all of these financial institutions. We see Q1, everybody is predicting it to be negative. The green is from Morgan Stanley. The numbers there are just as a perspective for you guys. So 3.4% is what they're projecting in Q1. Q2, everybody and their brother is projecting that it's going to drop. All right, we know that, we can see that, we can feel that. The predictions for Q3 and Q4 are what's important. And as you see, everybody with the exception of Wells Fargo is predicting a very positive Q3. Everybody is predicting a very positive Q4, hence the V-shaped recession. All right, so that's where that's coming from. That being said, there's a new poll that had just come out that was done by Reuters. Right? And so they interviewed, or they took a poll of 45 economists. This is throughout the US and Europe. And they asked them, what do you see for a recession coming? 22 of them are predicting a U shape. Right? That's not super awesome. 10 are predicting a V. 7 are predicting a check mark shape, which I think is somebody got bored with the letter V and made up their own term. So I would call that a V. A W shape is kind of also I would pretty much just say someone made that up also. But maybe down, up, back down, up, and then unknown, right? So this is what 45 economists are having to say, right? So we have a lot of different information floating around here, right? And so we have the business science, we have the health science, and we have the social science that all has to play into these predictions. And so getting all three of those to line up, good luck. All right, and I think that that's largely why we're starting to see some different predictions with the recession. All right. So now here's a quote from the Harvard Business Review. It's worth looking back at history to place the potential impact of COVID-19 empirically. In fact, V-shapes monopolize the empirical landscape of prior shocks, including SARS, the Hong Kong flu, the Asian flu, and the Spanish flu. All right, so this is the science, this is the research. JP Morgan came out recently, said the COVID-19 recession might only be a couple months old, but a few signs of the always hoped for V-shaped recovery are starting to emerge, right? So it's a big deal that these people are coming out and saying this, right? So why is this important, right? These are the leaders in the industry with finance. These are the university leaders, right? And so here's a very important quote for you guys, right? Charles Wardle: a bird sitting on a tree is never afraid of its branch breaking because its trust is not on the branch. The trust is on its own wings, right? And the point being, This is an event-based issue that we're having. If the coronavirus never hit our shores, we would not be on Zoom right now having this conversation. All right. So with that, the underlying economy as we were going into this was tremendously stronger than it was in, let's say, 2008. All right. So from here, between JP Morgan, Morgan Stanley, and Goldman Sachs, as we said, they manage $1.7 trillion. What's going to happen if they get these predictions wrong? How many hundreds of billions of dollars are they no longer managing? They all agree. All the academic institutions are agreeing at this point. That's good news. Here's the bad part. Nobody knows what's going to happen. Andrew's been saying that. You're going to hear it from me. All right. So here's a better example. Dr. Fauci. He can't tell us when the pandemic's going to end, but he's on TV every day, in the morning and at night, and he's not hiding from the fact that he can't give perfect advice. He's giving the best advice that he can. So that being said, based on what we're seeing, what we know, and what the science says, we're expecting to see an incredibly sharp drop to the bottom in Q2. Buckle your seatbelts. It's going to be fast. And we're going to have a skyrocketing ride back up Q3 into Q4 into 2021. All right. It's the best we got right now. So that's recessions. From there, let's talk about unemployment. The unemployment report did just come out this morning for last week. All right. So 4.4 million claims were filed. So you see the trajectory here, 3.34, 6.9, 6.6, 5.25, then 4.4. All right. So that's good news. That being said, there are only so many jobs that can be lost. All right. So the important question we need to ask is who's losing their jobs and what industries are those taking place in? All right. And now we're going to take a look at the U.S. Bureau of Labor Statistics. This report, and I need to be obnoxious here for everybody just so we're all clear. This came out on April 3rd. Okay. This is outdated. It is old, but I feel it is important to give you an idea of who is losing their jobs. The numbers that I'm going to put up here is only indicative of the first 700,000 people that filed, not the other 25 plus million, right? Understand this. This is not accurate information, but it is going to paint a picture of what has happened, right? The next report comes out on May 8th. That's going to give us a very clear picture, all right? So here's what we have. Food and drink services, 60%. Right? You tell me when the stay-at-home quarantine, whatever we're calling this order, is released, the bars and the restaurants open up, are those people getting their jobs back? Oh, yeah. I don't know about you guys, but I'm going to go get some dinner. I'm going to have some drinks out of my house. How about child daycare workers? Those of you that have kids, if they ask for a raise, are you going to give it to them? Yes, please. They're coming back. Healthcare office workers, receptionists, hygienists, technicians, hospitals, right? One thing that nobody's really talking about a lot with the unemployment and with the economy is hospitals are taking it in the back end. They can't do the business that they normally do to keep the doors open. They're not doing elective surgeries unless it's corona-based or unless it's life-threatening. They're all on hold. These guys are all coming back. Construction workers are all coming back, right? We're going to get to the health and the strength of the market, and you're going to see why. These we know are coming back. That's approximately 72, 73% of the jobs of the first 700,000 that were lost. From there, we have the accommodation industry, retail, and temporary help services, right? Who knows when people are going to be comfortable getting on a plane or going to a hotel or going on a cruise. Retail, going to come back, right? There are reports coming out of China that the people are flocking to stores to go buy things, right? It's coming out of communist China. Take it for what you want. Last 10% are the other industries that have been going away. Things like the coal mining industry, they're going away and they're not coming back. All right. So this is a pretty good breakdown of what's going on with unemployment and who's losing their job. All right. So now the three key questions: when's the pandemic going to be over? When is the economy going to come back? And when are people going to go out again? So what we have here is a study that was done by PricewaterhouseCoopers. And they surveyed a bunch of chief financial officers and they said, hey, if COVID ended today, how long until you're back online full speed? On March 15th, 66% of them said less than 30 days. 2 weeks later, those numbers shifted to the right. And this is what's concerning. We went from 66% to 36%. So 30% of those businesses said, we can't do it in a month. We see that it's just continued to push to the right, 40% in 1 to 3 months, 24% in 3 to 6 months. That's doable. As of April 14th, those numbers continue to shift. And this is what's concerning. We're now down to 22% of the businesses that can come back in under a month, 39% in 1 to 3 months, right? That's great news. What is concerning is 22% in 3 to 6 months, no massive change there. But now we have the 6 to 12 and the 12 plus. So we have 13% of these CFOs said it's going to take us 6 to 12 months. 5% said it's going to take us at least a year. I'm concerned that that 5%, those businesses aren't coming back. They're gone. Sorry, right? This 13%, right, without getting into politics in any way, shape, or form, if the stay-at-home order continues into the middle of May, I fear that 13% is going to be gone too. They're not coming back, right? They've already continued to push and push and push and push as far to the right as they can. All right, so this is something that's very important. We're not going to have another one of these surveys to kind of update this until we get to the end of the month, probably another week or two. So from there, here's the unemployment projections from Goldman Sachs. 2020, they're predicting 15%. That is the most conservative number or the scariest number. Congressional Budget Office is 12%, Merrill Lynch at 10.6, JP Morgan at 8.5, Wells Fargo at 7.3. Right, so let's operate off the worst case scenario, 15%. In 2021, Goldman Sachs is predicting somewhere between 6 to 8%. 8% is that kind of dividing line where if we're at 8 or higher, we have ourselves a very substantial issue. All right. 2022, they're predicting 5%, 4% at 2023. So we see it's coming down. We know that that's going to happen based off of everything that we're seeing. Okay. It's just going to be a function of where you see businesses that are going to take 6 to 12 months, businesses that are going to take more than a year. What about the accommodation industries, right? How many of you are going to take a free cruise if I offer to buy you one right now, right? I would not take that if I were you, all right? So those are the projections. So what does the science have to say about all this, right? And there's two questions we need to ask. What's going to be the depth, meaning how many people, what percentage, and what's going to be the length, how long? So here, let's take a look at some past financial crises. There's the Great Depression. It lasted 12 years. There's 1930 to 35, 25% in 1933. Here's the Great Recession. So this is from 08 to 2013. We know it lasted about 9 years. We had 3 years where we were above that 8% mark, right? 09, 10, and 2011, right? So when we look at the Great Depression, we know that we have a lot of depth. There's a lot of people that got affected by that, and we know the length was there. With the Great Recession, we didn't have the depth necessarily, but we had length, right? If then any of you who are homeowners or were having job issues going through this, you're fully aware of this. Here's what we have with COVID. These are the projections that we were just looking at. 2020 is projected at 15%, 2021 at 6 to 8, 2022 at 5, and then at 4%, right? So here's a better way of drawing this out graphically for you guys, right? So the depth is going to be up and down. That's going to be our y-axis. X-axis, left to right, is going to be the length. This is the Great Recession. Here's the, depression. Here's the Great Recession. This is COVID. That's pretty powerful. All right, so do we have the depth? Yeah. Oh yeah, 15% is legit. There's a lot of people out of work right now. Will we have the length? As of right now, the best projections we have, no, we will not. And that comes to the underlying strength of the economy going into this. All right, so there's a little bit of the science for you. So now let's get into the housing stuff. This is what everybody is mainly here for. The picture on the left is going to be the big message. A recession does not equal a housing crisis. All right, what we have here is a health crisis that is creating a financial crisis. All right, so when we talk about the housing issue, the biggest question that I'm getting asked is this going to be 2008, 2009 again? All right, so let's look at that. We've seen a lot of the data already going through this, but back from 08 to 09, there were a lot of causes, but 4 of the big ones that contributed to this. Lenders were giving loans out that they should not have been. Some of them were predatory, and I'll have Andrew talk about that in a minute. Buyers were making ridiculous purchases, right? If you're a kindergarten teacher and you walk into a loan office and you tell them you make 150 grand and you buy a $6 million home, you're dumb. The end. Sorry, I can't help you. So when we have lenders taking advantage of people being dumb, you have a market that is overbuilt. and you have home equity positions that are next to nothing, we have that neat little nuclear explosion there on the bottom. All right, so let's dig into this. Andrew, if you want to take over here, talk a little bit about the Mortgage Credit Availability Index, talk a little bit about the dip, what was going on in 08, 09 on the lending side, and kind of how that we've transitioned out of that.
Yeah, it's interesting. I got into the mortgage business right about that time. So I lived through that as I was getting into the business right after I left active duty serving in the military. And it was interesting because it just began to show how difficult it is to get a loan, basically. What the credit requirements are, what the lending standards are. And it also ties into the availability of funds and programs. Earlier on this presentation, I talked about how right now, jumbo loans have all but gone away. They haven't gone away, but they're just about gone right now because there's no liquidity for it. You're seeing lenders raise their minimum FICO, credit scores. I didn't mention this earlier, but for those of you guys who are still on the call, please help me spread the word on this. Forbearances. If you're in a forbearance, like basically nobody will lend to you. So be careful if you take a forbearance. If you need a forbearance, if you've been laid off and you can't make your payment, that tool is available to you so that you don't lose your home. I'm not saying not to do that. The temptation though is to go, well, it's there. I might as well take the break and not make payments for a couple of months. Don't do that unless you have to. If you have to, you have to. No, that's okay. Okay. But don't do it out of like, gosh, I don't know how much, how long these cash reserves are going to last me. So let me go ahead and take this forbearance right now, because it will hurt your credit, and most lenders won't lend to you right now. And so that also speaks to a tightening. It also speaks to this Mortgage Credit Availability Index where as things start happening to people's credit, which is more of a symptom of the underlying economic conditions, right? We had the same problem in the Great Recession. People were losing their jobs. They had acquired massive amounts of debt because rates were so low. They could get easy financing, easy loans for toy haulers and motorcycles and RVs or whatever, right? So people acquired all kinds of consumer debt. And then all of a sudden it came time to make those payments and they really couldn't, whether it was on their mortgages from shady loans that were made. And so what started off as a glut of easy money led to this massive hangover, right? Where people couldn't actually make their payments. And that then begins to impact people's credit scores, their debt to income ratios, their cash flow. And so then things start to show up, on credit in general, and lenders become nervous to lend. So right now lenders are nervous to lend because they loan to somebody who may be furloughed. They don't know if their job's even ever coming back. But if I give this guy a loan, I mean, this is a real simple question. If I give this guy a loan, can he pay me back? It's really, really the question. So this mortgage, credit availability index, speaks to the availability of money, based on either loosening or tightening of credit guidelines, and things like that. So as you can see, in the mid 2000s, it went so high because if you had a pulse, you got a loan. There was no standard in lending. Like it was like, if you can fog a mirror, you can get a loan for $1 million and no money down, and we don't care if you got a job. Which led to obviously a tightening. And the graph isn't super expanded, but I can tell you, if you look on that low end there where it says like looks to be about 100 on the low end of the graph there, that's when credit standards were really tight, as a knee-jerk reaction, swinging back the other way from loosey-goosey, get a loan for whatever. It only went up to like, say, 200. There's been a lot of really loose changes that have happened in that time frame. That scale, it doesn't almost look like very much because we're accounting for this time period back in the 2000s. And then the blip down to today, it looks so small on this graph, but I can tell you there's been some real impactful changes in the last month with credit scores and things like that. So anyway, If you can keep, I will tell you this, if you're listening to this not live or afterwards, if you've got reserves, if you've saved and you've got financial reserves, and you can make your payments even while you're between jobs, or maybe just temporarily laid off and your job will come back, you can make your payments right now. If you can hold on and maintain good credit, there's going to be a lot of people who can't, unfortunately, and their credit's going to take a ding. There will be some impact to housing as a result of this in the economy. There will be an impact. Ryan just went through all of that. And in that time period, there's going to be some opportunities. Be the one who's preserved their credit and their cash and has the opportunity to go in and buy that investment property or that second home, while everybody else is salivating on the sidelines, wishing they could be in the game. You could maybe be in the game. I'm going to tell you, that's my plan personally. So,
yep. I love it. I love it. All right. Next one coming through, percentage of median income needed to purchase a median priced home. 2006, it basically would cost somebody a quarter of their income. Today we're at 14.8%. All right. So Andrew, I don't know if you want to talk about that with debt to income, or if you have anything to add.
Yeah, I'm not as familiar with this particular chart, but I think, this is, I would just say that lately, especially in Southern California, you got to, I don't know if this is specific to San Diego or if this is nationwide statistic.
National.
Okay, yeah, because the thing is that here in Southern California, home prices are high. And in reality, what I've seen is that what I look at is what's called the affordability index. And it's basically what percentage of people, with median income can buy the median priced home. And that's essentially what this is the affordability index. And that affordability index is been getting worse and worse, particularly here in Southern California, where homes and land is at a premium, and we're out of land here, and so we're all built out in San Diego. So supply has got it's curved off here, where it's not like you go out to the Midwest, you go to Texas, Oklahoma, wherever. Home prices have a really strong headwind that they run into. And that headwind is that there's so much land, builders just keep building more properties. So the supply you're competing with the new amount of supply that keeps coming to market. Here in Southern California, not so much. I mean, there are new home tracts out there, but I mean, you can practically count them on one hand, and for the most part, any new builds are scraping a house and putting two where one used to be. That, that's adding a couple of units. That's not adding 10,000 units like was what happened. There are home builders in Texas and Oklahoma that are building 10,000 homes a year. I mean, you want to talk about adding to the supply. We don't have that here in San Diego. What that means is that your investment or your purchase here is probably going to be relatively stable in terms of cost, because it's fundamental of economics, supply and demand. The demand may shift. The supply in San Diego, in Southern California, it's going to be pretty much what it is, The demand may ebb and flow with economic conditions, people getting their jobs or whatever. So that's something that's kind of unique about where we live here in Southern California, which provides a really good opportunity.
Yeah, no, for sure. For sure. All right, let's keep moving. All right, so I said we're going to come back to months worth of inventory. This is a national graph. Let's start off there. So, all right, months worth of inventory is used to determine the health of a market, right? So 6 months of inventory. So months of inventory, if we stop taking new listings today, divided the amount of time it takes to sell into it, that's months worth of inventory to sell them out, okay? 6 months is considered to be a normal, healthy market. 7 months of inventory is a buyer's market. The slide here is saying 6 months. I would say in San Diego is 4 months worth of inventory puts us into a seller's market. All right. So if we take a look at what was happening in 06 to call it 2012, we see that it was a buyer's market. We had a lot of homes for sale. We were overbuilt. If we look where we are today, we don't have that problem, right? So if we take a look at the graph that's coming in, 8.2 months was what we had in 2007. Today in San Diego County, 1.8 months worth of inventory, right? Very, very different situation than what we had in 2008, all right? From here, Andrew was talking a little bit about this with the total equity cash out, all right? And so 2 charts, the one on the left is from 2005 to 2007. Where Americans basically cashed out around $824 billion of their equity to fund their lifestyle. They're buying the toy hauler or the new car or the second home, whatever it was, right? $824 billion. In the last 3 years, 2017 to 2019, that number's down to 232 billion. So that's $500 billion ish less, right? 600 because my math is bad, apparently. Americans learn their lesson. They learn their lesson. Their house is not their piggy bank. All right. And so, Andrew, is there anything you want to add to this? You were talking about it a little bit before. These are just the actual numbers.
No, I mean, it does speak though to, the chart a few slides back where the mortgage credit availability index was higher, meaning that the standards for lending were lower and allowed people to pull out all kinds of money, which led to this crash, which created this instability. Mm-hmm. Lending guidelines changed to protect our collective economy. And that's why I think, even though home values have gone up so much, that's why you see so much less cash coming out. Lending has guidelines have muted that to a point where people can take a little bit less out. By the way, that's probably a healthy thing,
Mm-hmm. Yeah, absolutely. All right. So here's a quote. This is with the chief economist with CoreLogic. He came out and said, our home equity report found that at the start of 2020, homeowners with a mortgage had an average of $177,000 worth of equity in their home. That is a tremendously different position than we were in 2008. Right? And so let me put it to you this way. If you own $177,000 in equity in your home and the housing market does do what it did in 2008, but let's say it takes a 25% hit instead of a 20% hit. Your 177 just went to, I believe it's 126,000. Are you walking away from that? Don't think so, right? People aren't going to walk away from their homes like they did previously, right? So we're laying out the evidence, we're laying out the science behind what's different right now than what we had in 2008, right? And so here's a little bit more on mortgages. 53.8% of the homes in the U.S. have at least 50% equity. That's a big number, right? 37% of the homes in the United States are owned outright. There's no mortgage. 26.7% of the homes that do have a mortgage have at least 50% equity. That is a tremendously different position than we were in 2008 when we had a really big housing problem, right? From there, we want to talk about home appreciation, right? If we look at the bar graph on the left with the red, that's the 6 years leading into 2006, right? So 2000 to 2005. You can see the appreciation, 12.5% appreciation, right? It was out of control. There was, and it's overbuilt. If we look at the version on the right, which is the last 6 years leading into 2020, we see a very different story, right? And if we take the best year out of our last six, 2017, that's not even high enough to displace one of the earlier ones. 6.4, the lowest one that we saw there was in 01 at 6.5%. Right? So when we talk about equity in a home, and when we talk about appreciation rates being under control, these are two very, very different situations than where we were at in 2008. From there, what about home pricing during recessions, right? In the last 5 recessions, 3 of them had appreciation, 2 had depreciation, right? So in 1980, we were up 6.1, in 81, we were up 3.5%. 1991, that was the Gulf War recession, we dropped 2%. 2001, that was right around the dot-com crash, September 11th, we increased 6.6%, and then we have the big scary number of 20% down in 2008, right? The housing market led the way to that financial crisis, to the recession. That was a housing market, right? When we look at the projections of what's coming up in our future, right? The projections pre-COVID was a 4.7% appreciation in 2020. They've now downgraded that to 3%. Not good, not terrible. 2021 was projected at 3.8. It's now projected at 4.2. There you go. 2022, there were no projections pre-COVID. Now they're projecting it at 4.6. All right, so that's what the science is having to say. All right, this is the best that anybody can give you. All right, so based on what we know, based on what we see, and based on what the science says, we have fewer homes for sale. Appreciation rates are under control. People have a tremendous amount of home equity. Andrew's spoken very well about the mortgages and what's going on there, and the home value prediction. Right? So there's a lot of people, I got this question a couple times on social media and through some other email channels. Are we looking at 2008 again? This is why I don't think we are. right? The position that the housing market is in today is in a very, very different position than it was in 2008. The position that the housing market was in leading into the coronavirus recession was very, very different than where it was leading into the early 2000s. All right. So based on that, I think the housing market is actually positioned to lead the way out of the recession. That's a big difference. That's a big, huge difference for homeowners and for people that are looking to buy. All right. So this is the last quote that we have. It's from Goldman Sachs. If policymakers manage to thread the needle between continued virus control and gradual reopening of the economy, the level of GDP should begin to move higher in the months ahead. If you've never tried threading a needle, go give that a shot. And then let me know whether you think the federal government, the state government, and the local governments are capable of doing that exceptionally well. All right. So what does this mean? This is challenging, right? There are two competing forces. We have public health and public safety, which I believe everybody takes seriously. We have the entire economy. If those are two out of balance, we have a problem, right? If we continue to have this economy shut down, like the World Health Organization is saying, for the next 18 months, good luck. There will be nothing left, right? So that's basically where we're at. We know that things are starting to open up in the economy. Whether you're here in California, we're seeing this a little bit. People can go out and run on the trails again. Andrew, I'm sure that's making you happy. I know Christy's very happy about that. The beaches are closed up, right? Still can't go there. Still can't. My kid can't go play on the playground, right? So this is changing day by day. What we're going to do is try to provide as much valuable, honest, reliable info as possible for you guys. So let's open it up to questions. If anybody has any they want to type into the chat box, we'll check those out. I did have a handful that had come through earlier, Andrew, so let's go ahead and try to knock off a couple of these real quick. Let's start with a lending one. I think you kind of already spoke about this. They're asking how easy is it to get a loan. They're hearing that basically no one can get a new loan because of the refi. Is there anything that you want to put a finer point on that, or you pretty much covered all that?
Well, it's hard to know the context of nobody can get a loan. I mean, we're doing so many loans right now, like more loans than ever. I mean, I think our team we got over 100 loans in the pipeline right now, just for my team, you know. Mm-hmm. So I think I did speak to the long lines, so to speak. I gave this sort of Costco analogy, and everybody wants to refinance. I gave this idea of just to give people a sense of how much mortgage debt is out there and how much is in a window where it does make sense to refinance. And the industry as a whole literally does not have the capacity to do all of the loans. What it means is that relationships are going to be more important than ever. I mean, just to be totally honest, I mean, you know, I've got a massive past client database, and I'm serving those first, those people who I have a relationship with. There are only so many hours in the day. So just take this just from a loan officer who also manages a team of other loan officers. Take this as a person who just is a person out there grinding every day trying to provide for his family, but who's a professional in the mortgage business. There are only so many hours in my day. I just can't, right? So if I have 100 people call me today, I just physically cannot handle all of that. Mm-hmm. And a huge chunk of those people who call me randomly today are people who are just looky-loo shopping around going, hey, what's your rate? And as soon as they hang up with me, they call two other people and go, what's your rate? What's your rate? And it's like, listen, you know who I'm going to take care of right now because I've only got so many hours in the day? The client who I closed last year, I helped him buy his house. I know him and his wife and his kids. He appreciates me. I enjoyed working with him. He calls me and he says, hey, Andrew, you know, last year you helped me and my wife buy this house. We love it here. And I'm giving you the other end of the spectrum, right? You know, and we heard rates are low, and I'm like, absolutely, it's a great time to refinance. Send me over your latest mortgage statement, your proof of insurance. I'll crunch some numbers, present you with a couple of options. It's like battlefield triage. Like that's who I'm going to help first. I can only help so many people, and I promise you, it's not to be mean or disrespectful. I just understand, like, that what I just articulated is going through the minds and daily routines of 1,000 other mortgage professionals as well. So if you say like, hey, it's impossible to get a mortgage, the industry is overwhelmed. We as an industry cannot keep up right now. And so I will tell you that what we are doing, though, for sure, is we definitely prioritize our purchase loans. And I would tell you that not all banks and lenders do that because, when you're under contract to purchase, there's a contract and there's a timeline that you are contractually obligated to close by this time. Otherwise, the seller could cancel on you or there could be financial penalties, et cetera. So those get the first of our attention. The refinances, if we've locked in the rate and the rate's protected for 60 days, we can close that one in 40 if we have to. We're not taking that long to close refinances, by the way. But I'm just saying what we're doing is we're having to manage our capacity that way. So you might be experiencing that. It is still possible to get a loan. I'll give you a little insight. I mean, this is going to sound corny, but if you call a mortgage company or somebody needing help to get a refinance, be nice to them. People in the mortgage business are just overwhelmed and exhausted right now. And a little bit of appreciation goes a long way. I'm just telling you. Look, I rise above that every day. I get people that call me and they're like, well, look, man, I just want the number. Can you give me a number? And I'm thinking here going, oh, this sounds like a lovely person. I can't wait to work with them, and I got a line 100 people long of my past clients who know me, like me, and I like them. Like, who am I going to help? And that's just human nature. And I'm not trying to be mean. So, but just a little piece of insight,
Yeah.
If you are kind and appreciative to some mortgage folks, they may be more willing to help you just because they're tired and just would love to be appreciated. So
yeah, that's not what it's who you know. I agree with that. All right, another one that came in: are we expecting to see home values go up or down? I think we addressed that pretty well with the last part of the slide, so we're not going to go back through that one. Are we expecting to see a lot of distressed properties? All right, so I'll hit that from my side, and Andrew, if you want to add on to that. Basically, through everything that we just laid out, no. That's the simple answer, right? We talked about the equity. We talked about the $177,000 being the average amount of equity in someone's home that they have a mortgage. They're just not walking away from it. We look at the amount of equity that has not been removed from the property. I just simply don't see this coming. There are not going to be, at this point, a bunch of foreclosures, short sales, things going along those lines. Things can obviously change. Andrew, are you seeing anything on your end with any flags that are popping up for that?
I'm not yet, but just know that there are likely to be some people in distressed situations, on a macro scale. Remain to be seen how San Diego and Southern California is affected specifically. It's absolutely going to depend on how the rate at which different governors reopen their states and get people back to work. But absolutely, there are going to be people who their job just doesn't come back or doesn't come back in time where they can save their home. And it's unfortunate. I've lived through this. I've seen this. I've experienced it personally. So there will be some of that. And some folks who I mentioned earlier take the forbearance or skip some payments because they're struggling financially right now. Again, for obvious reasons, not through financial mismanagement, not through I don't give a rip and don't want to pay my bills, but through actual hardship. Okay. There are going to be people who are casualties of this, unfortunately. And I think that on the other side of the coin, as I mentioned earlier, that's going to create some opportunities if you can maintain your credit, if you've been saving for the future, you've got some reserves, and that won't be everybody, but look, keep making your payments if you can, keep your credit clean, because there may be some opportunities, unfortunately, as a result of some other people having some hardships, but that's the ebb and flow of economic cycles. Okay. This is just the seasons that happen and you can look back and see these cycles. And so if you can prepare for these cycles, maybe you can also be in a position to take care of the future of your family when some of these cycles down cycle, and you can step in and maybe pick up a good deal here or there. So I do think there will be some of that.
I think there's going to be some. I think the other part of that is going to be that is a positive for us, right? In 2007, 2008, the government sat on the sidelines. They did nothing. They did not step in. Federal government and state governments and city and even county governments are at this point, they have stepped in. There's the forbearance. There is the whole pause on evictions. There's the stimulus. So the government is actively involved, which I think will stem that. But there are going to be people that are going to have issues. And I do not think we're going to see it like we saw it in 08, 09. So, all right. So next one, let's see. How are you getting business? I'll let you start with that.
I mean,
Is there any change for you guys with this?
like, are we getting business?
How are you getting it?
Where am I actually getting it from? Like, where's my actual business coming from? I mean, I've been in the business for a long time, relatively speaking. I've been call it 13, my 14th year in the business. And so I would just, the medium length answer to that question is I've never been somebody who's just been strictly transactionally focused. I've built long-term relationships with my past clients and tried to stay in touch over time and continue to nurture those relationships and stay in touch. And so right now I have the benefit of a database and 13 going on 14 years in the business of compounding relationships. So I have a lot of past clients coming back to me, and I take care of them, and they say, I do a refinance for a past client, and I get done, and they go, hey, I'm going to send you two of my buddies at work right now who just heard about the deal I just got. So it's, for me, it's all referral.
Mm-hmm.
It's referral, and then just doing your best to take great care of each person, such that they refer you. I mean, so to answer your question, that's how I get my business.
Mm-hmm. Yeah. On our end, it's all online at this point. When the offices are closed, we're not doing in-person open houses, so everything is online. There's a Navy couple out in Hawaii. They're being PCS to Miramar, right? And they found us online, answered the phone, and now we're off and running looking for something in Poway. So that's kind of how we're looking. Another question was, are we seeing a lot of deals dying? Do you want to start us off with that one on your end? You guys seen
So far, I'm not. Although I did just have my first turned down as a result of the forbearance. It was a client that was referred to me by another past client of mine, and they wanted to do a refinance.
Mm-hmm.
And we collected all the paperwork. The numbers made sense. They were almost giving them a smoking deal, 0.5% lower than their credit union, which usually credit unions are really strong rates, but I don't know. So she's like, "Oh, we would love to go with you." I'm like, "Great." So we start working on everything, and then like the conversation, she goes, "Oh, by the way, one of my rental properties, they have two rental properties, is in forbearance right now." And I go, "Ooh, okay. I don't know if we're going to be able to do your loan. So it's just the rental property, not your primary residence, that we're doing this refinance on?" She's like, "Yeah, not the subject property, not my primary that we're refinancing with you. It's our rental property." I'm like, "All right, well, maybe we'll be able to do it since it's not the subject, right?" So let's keep going with the process here. We went like another 2 days, and all of a sudden policy came out that it's if the borrower has any property in forbearance. And so that's the only situation for me. Now, in terms of loans under contract, like purchase deals, I haven't had anything fall out yet. Nothing yet. But I think, look, if somebody loses their job, I mean, that's a material change that I think, I mean, they can't buy. They can't get the loan. I mean, that has not happened to me yet.
Yeah.
But as the unemployment numbers continue to go up, you can bet you'll see more of it. It will happen. And some people who were going to buy may go, "Listen, I'm furloughed. My boss says that we expect to be rehired within a month or two. But so as of right now, we're going to put this home search on hold," which makes sense, right? I mean, if you think so anyway, I hope that answers your question.
Yeah, no, that does. On our end, we know that they are happening. We haven't seen any of them as a team or as a group. When this initially happened, we had quite a few sellers that were ready to come on the market about a week or two after that, that hit the pause button. But other than that, we really haven't seen that. I think a lot of it goes to the way that we will pre-qualify people. So it's a thing, if we're representing a seller, there are hoops that buyers have to jump through at this point to even get into the property. The level that we're vetting buyers at, the level that we're vetting their lenders at, are incredibly high originally, and now they're becoming even more stringent. when it comes to us working with buyers, we're basically applying that same standard, but to our own clients, so that when we do write an offer, we've already checked all those boxes. And that's something that I'm continually communicating with the listing agent in that scenario. So I know it's happening. We're just not seeing a ton of it. Next question was, how are you guys being safe out there doing business? So I don't think you guys aren't out in the field very often. So not a super huge lending question. In terms of what we're doing, we basically are respecting the social distancing to the absolute best of our ability. A lot of our vendors, photographers, videographers, home inspectors, appraisers, they're being very clear that they do not want people in the house while they're working. Other than that, we've moved a lot of stuff to being virtual buyer consultations, virtual listing or marketing presentations. I've spent more time talking to my computer in the last month than I have in a long time. So that's basically what we're doing. The face mask, we'll have gloves on and booties anytime we're in somebody's house. And that's basically what we have going on with the being safe part. A lending question, Andrew, someone asked, and I know a lot of these lending questions, no two borrowers are the same, I think would be a relatively reasonable statement. So situationally dependent, but the question was, should I lock my rate in now since they're so low?
There's an old saying in the mortgage business, and it goes back to what I said in the beginning about bird in the hand is worth two in the bush. I mean, a lot of experienced lenders will tell you this, which is, if you like it, lock it. Okay. Little quote, whatever. It's the sorry, my computer is it's the bird in the hand is worth two in the bush. We cannot, the volatility has been pretty significant lately, and if you don't lock it, then if it goes against you, you got to hope it comes back, and the opportunity to refinance may go away forever because it may no longer make sense. And what's that? If you refinance, if you lock it and the rates get a little bit better, it's like you still got savings. You still definitely got some savings. Mm-hmm. It's like you got a lot of juice out of that orange. Maybe you didn't get the last drop, but you got a lot, right? Yeah. Whereas if you don't lock it and it goes back up, you get none. So mm-hmm. that's my take. I mean, if it makes sense to refinance. Mm-hmm. Most of the time what I've seen, not all the time, okay, but most of the time, those who go, well, maybe it'll go from 2.75 to 2.5. Let's wait. You're trying to squeeze that one last drop, and you end up losing out. So that.
Yeah. All right, let's do one more. The one that came in was more of a realtor question, but let me turn the question around. I'll start with you, and then I'll answer on the real estate side. Somebody's coming to you. They need to buy a house. They have to buy in the next 30, 60, 90 days. Reasonable credit. There's no red flags that are immediately popping up. What's the best piece of advice you have for somebody who needs to buy and needs to take a mortgage out for that at this point?
Are you taking that one, or am I?
You. So from the lending side, somebody needs to buy. What's the best piece of advice you would give them currently?
Don't miss any of your payments. I mean, don't do any of the forbearancing if you own any other properties. That's the number one thing. Don't miss payments. I mean, people like right now figure, oh, it's a hard time. Maybe we'll understand. I mean, you can slam your credit, That's the biggest thing. You can't control whether your company lays you off due to the economic hardships, but I definitely would not, just what you can control is making your payments, there's choices you can make. I mean, there's things you want and things you need. Some people go out and buy a new car and they love the new Beamer, but the $600 a month car payment, well, there went your house. So keep your expenses low. That's what I'd say.
Yep. Yep. All right. Good deal. And then so the original question was best advice I would give to somebody who's selling their home. At this point, I would tell you put the house on the market. Put the house on the market. There are multiple properties that we have either had listed when this started or we have brought on the market at this point. They are all selling. There are no major price reductions, and they're selling relatively quickly. So I would tell you that if your home is not on the market, it is not going to sell. A lot of sellers have asked about, what about running up my days on MLS to which my answer is whether I'm talking to a seller or I'm talking to a buyer, the days on MLS are becoming far less relevant right now. We need to be able to rewind whatever that day is to see where that relates to March 19th. Right? And so I think that if we get 2 months from now and we've come out of this a lot more completely, your home, let's say, is still on the market and all of a sudden it's been there for 78 days. If the agent that's representing that buyer, if the buyer isn't smart enough to look at that and look at a calendar and go, oh, well, it was on through the entire pandemic, maybe they're not the right buyer for your house. Right. And so that's the advice I would give you for people that need to sell. So I think we're well over time at this point. So let's wrap this up. Andrew, thank you very much for your time today. Do you have anything you want to end with?
No, I've given a lot of pieces of information, especially in the beginning. I don't want to over talk here, but if you've got any specific questions, you can reach out. There's my email address there. I'm happy to help address any other questions you guys have. Thanks for having me here, Ryan.
All right, that sounds good. So that's all we got for today, everybody. Hope you guys got some good info. Those of you that had to pull off early, we are going to send the recording out and we're going to get this up on YouTube. Also, if you guys have any other questions, the contact info was just on the past slide. Thanks for coming, and we'll see you guys next time.